Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, good morning, everyone. So basically, after the mid-semester break, it will be one of the public holidays. So it's Easter Monday, so that's on the 22nd of April. So basically what will happen is we're going to have a makeup lecture on Wednesday. Same location as last time, Barry Drive, all right? So don't worry, I'll make announcements on the Voto to remind you guys that we're going to have a replacement lecture for the Monday, Easter Monday break, public holiday. Okay, so I promise you guys we're going to finish the trading strategy today. So I'm going to go through the trading strategy first. Then we're going to talk about this week's workshop, which is application of Black-Scholes option pricing formula. Okay, so I've talked about the long straddle. That was a while ago, so I would like to do a quick recap. What is this long straddle is all about? So basically, long straddle is that you're going to long a call option and you're going to long a put option with the same strike price, same date to maturity. And the motivation to set up a long straddle, as I mentioned before, is that you expect the share price to become really volatile in the near future, right? Now, one of the examples I gave you guys is that we have an insurance company called QBE listed in ASX. So just imagine if QBE is subject to a takeover bid, takeover offer. Just imagine there's some insurance company in Europe and think that QBE is a really good asset to purchase, so they announce a takeover bid and they wish to buy QBE. So what will happen within next month is that QBE share price is going to be extremely volatile. We don't know the direction of the share price. We don't know whether the share price is going to go up or go down, because there's a lot of uncertainties surrounding the takeover. Because the shareholder may approve this takeover, may not approve, and that European insurance company can withdraw their takeover offer. So anything can happen. You know, share price can end up being really high or end up being really low. But it doesn't matter. As long as we suspect the share price is going to be really volatile, we're going to straddle QBE share. And as I mentioned in week 4, the way we're going to straddle the QBE share is to buy a call option with a strike price of $9.75 that expires in April. And we're going to buy a put option with the same strike price, $9.75, also expire in April. All right, so the way we choose the strike price is that we're going to look up what is the current share price. And then we're going to choose the strike price that's really close to the current share price. So the current share price is $9.64. And I look up in a newspaper, I look up in the ASX exchange website that this two strike price is mostly close to $9.64. Okay, so I paid 14 cents to buy the call option with a strike price of $9.75, and I paid 27 cents to buy this put option, and yeah, so that has the strike price of $9.75. So the way I taught you guys to draw the graph is to use a payoff diagram, right? We've done that before, so we're not going to do it today. We're just going to jump straight into the payoff diagram of this long straddle. So basically, this long straddle really just a combination of a long call. So let me go back. So first of all, we have a long call. Then we have a long put. So even without drawing the payoff of the long straddle, you can almost visualize it's going to be a V-shaped payoff diagram, right? Now, if the share price end up being really high, if this takeover event eventuates successful, then the QBE share price will jump up. If the share price get above $10.16, so here is the break-even point. Sorry, here is the break-even point. If the share price increase above $10.16, we're going to make a positive profit in this region here, right? So the way I get $10.16 is by taking the strike price, $9.75 plus the setup cost. Setup cost is 41 cents, remember? So the way we set it up is we pay 14 cents to buy the call, and we pay 27 cents to buy the put. So in total, we paid 41 cents, right? Now, in order for this strategy start to make money, we need the share price to get above $10.16. So once it get above $10.16, we start to make a positive profit here. Okay, now if the share price end up being really low, if this takeover event failed, now, what if the European insurance company withdraw their takeover bid and this takeover did not eventuate, then the QBE share price can, plunge. If that happens, if the share price gets below $9.34, then we also can make a positive profit here. So the way I get $9.34 is I take the strike price, $9.75, subtract the setup cost, 41 cents. Then I get another break-even point here, right? So $9.34. Now, if the share price falls below $9.34, we can still make a positive profit here, right? Now, the worst-case scenario is that share price finish right at $9.75. If that happens, the maximum we're going to lose is, in fact, the setup cost, 41 cents. So that's this pointy bit here, right? So the 41 cents is simply the 27 cents were paid on the put, and 14 cents were paid on the call. Does that make sense? How this strategy make money? Yes? Okay. So I think everybody understood the motivation of setting up a straddle. So in week 4, I also introduced there's alternative way that you can make money when you expect the underlying share price to become really volatile, which is strangle. All right? So strangle is very similar to straddle. Now the difference here is that we're going to buy the call option with the higher strike price. So I use K2 to denote the call option with the higher strike price. And we're going to buy a put option with the lower strike price, K1. Okay? So remember, back to the straddle strategy, the strike price is identical. $9.75, remember? So that was the strategy. Now with the strangle, we have different strike price. But the recipe is very similar. We still long a put, we long a call. It's just the fact that this time, the strike price is different. Now, ideally, we want the strike price to be further away from money. If going back to the previous scenario, you realize these two options is almost at the money, right? It's almost at the money. It's very close to the money. But this time, we would want to choose the options with the strike price that's further away from money. So what's the benefit of doing that? If we choose the option that's more further away from money, which means that we're going to pay less premium. to acquire those options, right? Because they are further away from money. Now, paying less premium means that we can put a floor, we can further reduce the amount of loss that's going to incur to us. So going back to the previous example, we're going to lose 41 cents, right? So this pointy bit represents the maximum amount of loss that's going to incur to us. Now, if we choose the options that are further away from money, then we can reduce that loss, right? So this flat bottom indicates we managed to reduce that pointy bit. Remember, that was the V shape, but because we choose the options that are further away from money, we kind of flattened the bottom. We kind of reduced the loss here. So that was the benefit of doing that. So what is the disadvantage? Now, the disadvantage is that you would require the share price to be even more volatile for you to start to make money, right? Now, the share price has to swing a much larger range for you to make money here. So that was the disadvantage. The advantage is that we managed to reduce the amount of loss that's going to incur to us. So let's implement the strangle. Again, we're going to implement strangle on QBE share, all right? So the QBE is currently trading at $9.64. So what we did is we bought a call option with strike price $10.50. So $10.50 is above the current share price, right? So that's out of money call option. We paid very little to buy the call because it's out of money, so it's very cheap. So we only paid 4 cents to buy it. All right, then we bought a put option. So the put option is $9.75. So it's slightly above the current share price. So this put option is in the money. We pay a bit more to buy the put. So we paid 27 cents. And the total setup cost this time is 31 cents. If you compare this setup cost with the straddle strategy, remember in the previous slides, we paid 41 cents. Now, because this time we choose the call option that's further away from money, we paid a lot less, right? We only paid 4 cents. In other words, by strangle the QBE, we saved 10 cents. Does it make sense? In the previous scenario, we paid 41 cents. But this time, because we choose the call option that's further away from money, so we paid less. Because it's out of money, so it's cheap. We paid 4 cents to buy this call. And the total setup cost is 31 cents. All right, so how can we draw the diagram? Again, I'm going to use the payoff diagram here. Now, if you think about our strangle strategy, we have 2 legs. So when I say 2 legs, I mean there are 2 pieces to this strategy. The first leg is we bought a call option, and the call option has a strike price of $10.50, right? Now, what we're going to do is we're going to list a range of possible share price that's going to happen between now and end of April. And then we're going to ask ourselves, do we want to exercise this call option? Okay? It's very simple. So what about the share price end up being $8.50? Do you want to exercise your call option? No, you don't want to, right? Because the call option has a strike price of $10.50. So that's way below. What about $10? Do you want to exercise your call? You don't want to exercise your call, right? Because that's still below your strike price. Your strike price is $10.50. Now, once the share price gets above $10.50, let's say $10.75, yes, you want to exercise your call option, right? Your strike price is $10.50. If the share price is trading at $10.75, yes, you want to exercise. And exercise your call is going to make a 25 cents payoff, right? And your decision to exercise the call will go beyond $10.75. So any price that's above $10.50, yes, you would want to exercise. Okay, as the share price go higher and higher, your payoff on this long call is getting bigger and bigger. So that's basically what it says. So that's just the first leg to our strangle strategy. What about the second leg? The second leg is that we bought a put, right? And we bought a put with strike price of $9.75. What's the decision rule here? We bought a put with strike price of $9.75. What should be our decision rule here? As long as the share price below $9.75, we would like to exercise, right? Because that's where the put option is in the money. Now, for instance, if the share price is $8, that's below $9.75, our decision is yes, we want to exercise. Exercise that put option will make $1.75. Now, when the share price is $9, yes, we still want to exercise, although our payoff becomes smaller, right? Because our strike price is $9.75. When the share price is $9, we exercise the put, we make 75 cents payoff. All right? However, when the share price gets below $9.75 or at $9.75, we don't want to exercise the put option. So the same decision going beyond that point. So as long as the share price is above $9.75, our answer is no. We don't want to exercise because exercising the put will lead to a loss. So we never exercise an out-of-money put, right? So everybody understand the rationale, right? Now, if we sum up the blue column and the red column, we get a gross payoff column here, right? So as you see from this gross payoff, if the share price is swing between, within $9.75 and $10.50 range, we are not making any money here, right? You see that? So if the share price is just bouncing within $9.75 or $10.50, we are not making any money here, right? Now, as long as the share price ends up being high-ish or low-ish, we start to make money. So that's the part that is similar to the straddle strategy. Remember, the straddle strategy also works like this. If the share price finish high-ish or low-ish, we make money. If the share price finish at the strike, we are not making the money. But that's just the gross payoff. Remember, we also need to subtract the setup cost. So the setup cost this time is not as expensive as the straddle strategy. So the setup cost is only 31 cents. So what we do is we subtract 31 cents from this gross payoff column. We get this purple net payoff. Okay? So as we can see from the purple net payoff column, the maximum we're going to lose is 31 cents, the setup cost. If the share price is bouncing within the range of $9.75 and $10.50, the maximum we're going to lose is 31 cents. If the share price finish high-ish or low-ish, we're going to make positive profit. Now, more specifically, if the share price gets above $10.81, we start to make a positive profit, right? When I talk about a positive profit, I mean the payoff net of the setup cost. If the share price gets below $9.44, that's the break-even point, we're going to make a positive profit here, right? So that's the whole essence of a strangle. It's quite similar to straddle, to be honest. Does that make sense? And noticeably, we don't have this pointy bit here, right? The reason we have that pointy bit is because our setup cost is a lot higher in the straddle strategy. The setup cost was 41 cents, right? So that was the pointy bit. Because this time we bought the call option that's further away from money, we only paid 4 cents. So we reduce the loss that's going to incur to us. So we kind of put a flat bottom to this strategy. And the maximum we're going to lose is 31 cents. So that's the main difference. Any question with the strangle? Any question with the strangle strategy? Yes, short. So basically, you don't want to set up a short strangle. The reason is similar to the short straddle is because you are exposed to unlimited loss, right? So short strangle and short straddle inevitably involve shorting a call or shorting a put. And the danger of shorting the call option is that there is no limit as to how much the share price can increase into, right? So basically, share price, there is no limit, there is no ceiling as to how much the share price can increase into. That means there's no floor as to how much you're going to lose on that short call. So that's a very dangerous strategy to enter into. I'll talk about the short straddle in a second, and how can we kind of put a cap in terms of how much we're going to lose on that sort of strategy, okay? All right, so let's move on to the next strategy, which is the short butterfly spread using call options. Of course, we can also set up short butterfly spread using puts. But let's have a look at the short butterfly spread using calls. So the reason why I'm introducing this short butterfly spread using calls is because the motivation behind that is identical to the motivation of set up a straddle, and is similar to the motivation of set up a strangle. Now, the motivation of setting up this short butterfly using calls is that we expect the share price to be volatile, okay? To end up being really high or end up being really low. If the share price is really calm and smooth, doesn't change much, we're going to lose. So in fact, this V-shaped pattern is very similar to the long straddle, right? Because the long straddle also have this V-shaped payoff. So how can we construct a short butterfly? All right, so first of all, we're going to short a call option with the lower strike price, K1. Then we're going to short another call option with higher strike price, K3. Then we're going to long two call options with strike price of K2. But we're going to cleverly choose K2 so that K2 is right in the middle of K1 and K3. To be more precise, the K2 has to satisfy this relationship, which is K1 plus K3 divided by 2 give us K2. Right? So basically, we take K1 plus K3 divided by 2. That's going to be the K2, the strike price that's in the middle. And we're going to long two call options with strike price of K2. All right? So imagine we have stock called XYZ, and the XYZ is currently trading with a share price of 12. And we expect XYZ to be really volatile in the next month. And it's ideal for us to set up this short butterfly using call options. So basically what we're going to do is first we're going to short a call option with the lower strike. So we're going to short a call option with strike price of 10. Okay? So shorting the call means that we are selling the call options. So this time we receive the premium. Okay? So we're going to receive 55 cents from this short position. And then we're going to short, another call option with the higher strike, K3. So we're going to short a call option with strike price of 14. Okay? So shorting this call also means we're going to receive premium. We're going to receive 20 cents. Then we're going to long two calls. We're going to buy two call options with strike price of 12. Right? So the way I get 12 is 10 plus 14 divided by 2. So I get 12. So 12 is right in the middle of 10 and 14. So I bought two call options, which means I'm going to pay 30 cents for each call. So that in total, that's 60 cents. All right? So if you work out the premium, the net premium is positive 15 cents, which means in net, we receive 15 cents from this strategy. Right? So we received 55 cents, we received 20 cents, then we paid 60 cents for the two call options that we bought. So in total, we receive 15 cents. All right? So once we set up this short butterfly spread with call options, we're hoping that the share price, is really become really volatile. Okay, so before I show you the diagram again, I'm going to use the payoff table. So the payoff table is here. So first of all, we have a call option, right? So the first leg in our short butterfly strategy is we short a call option with strike price of 10. Because we short call option, we sold the call option, we don't have the right to make the decision here, right? We don't get to make the choice here. Whoever on the long side of that call option can make the decision. So we have no control over that. But we know the decision rule, we can preempt what the call option holder will do to us, okay? So we can predict what the call option holder can do. Now, if the share price is below $10, whoever on the long side of that call option they don't want to exercise, right? Because exercising that out-of-money call will lead to a loss. However, once the share price gets above $10, so let's say $10.25, whoever on the long side of that call option want to exercise, okay? So they exercise their call and they will make a 25 cents payoff because their strike price is 10, right? So that's $10.25 minus 10, they're going to make 25 cents gain. We're on the short side, so if they make 25 cents gain, we're going to lose 25 cents, right? So that's us losing 25 cents on that short call. So a similar decision going beyond that point. So as long as the share price stay above $10, we're going to lose money, okay? So as the share price become higher and higher, we're losing more and more money on that short call. All right, remember we also loaned 2 call options, right? We loaned 2 call options with strike price of 12. So because we loaned the options, so we get to make the choice here. We have the right to make the choice. Now, what's our decision rule? Our decision rule is simple. As long as the share price stay above 12, we would like to exercise, right? Because that's where our call option is in the money. For example, if the share price increased to $12.25, so that's 25 cents higher than our strike price 12, we would want to exercise our call. So exercising that call, we're going to make 25 cents gain. Because we bought 2 call options, so we need to double that payoff. So that's 25 cents multiplied by 2, so we get positive 50 cents payoff, right? So that's the payoff generated from the 2 call options that we loaned. And the same decision goes beyond that point. So as long as the share price stay above 12, we would want to exercise, and we make more and more money. Okay, remember the last leg to the short butterfly is we short another call option with strike price of 14, right? So because we short that call, again, we don't get to make the decision here. And whoever on the long side can make that decision. And they're going to exercise against us if the share price is above 14, right? So for instance, if the share price is $14.25, the call option holder will exercise against us and will lose 25 cents. Okay? So same thing goes beyond that point. As long as the share price stay above 14, we're going to lose money on that call option. Now, if you sum up this blue column, red column, and green column, we get a gross payoff here. And when you look at this gross payoff, there's a pattern emerged, right? So if the share price end up being really high, end up being above 14, the net payoff is 0. If the share price finish really, really low-ish, finish below $10, the gross payoff is 0. If the share price is swing between this range, we're going to lose money. And the maximum we're going to lose is $2. Okay, if the share price finish exactly at the $12 point, we're going to lose $2. But remember, in this strategy, we have a net positive premium. We received 15 cents, right? So we need to take that into account. So once you sum up this gross payoff column with the net premium, we'll get this purple column here. So basically what happens is that if the share price is really volatile, really, if the share price finish high-ish, finish above 14, the maximum amount of gain we're going to get is 15 cents. So that's the net premium we received upfront. If the share price finish really, really low, below $10, the maximum amount of gain happened to us is, again, 15 cents, the net premium we received. If the share price finish within that range, we're going to lose. And the maximum amount of loss that's going to incur to us is $1.85. That's when the share price finish exactly at a $12 point. Okay, and this graph, detail exactly what I said. So this gray line represents the gross payoff, and the purple line represents the net payoff. Okay, so if the stock price is really calm and smooth, finish exactly at 12, we're going to lose $1.85. Now, if the share price is really volatile, either finish really high or finish really low, we're going to make 15 cents gain. Okay? So that's why I said the rationale behind the short butterfly is similar to the long straddle and the long strangle. They both have this V-shaped pattern. Does that make sense? I also introduced you guys to the short straddle strategy. So the short straddle, the motivation behind the short straddle is you would expect the share price is really calm and nothing will happen to the stock. So you would expect there's no earning announcements for the underlying share, and there's no other idiosyncratic events that are going to happen to the underlying share price. If that's the case, that you would expect in the next month, the share price would finish really close to the current spot price, $9.64. So that's when you set up a short straddle. So the short straddle is opposite to the long straddle, which is we short a call, we short a put with identical strike price. So they both have a strike price of $9.75. Because we short option this time, so we're going to receive the premium, right? So we receive 14 cents from the call and we receive 27 cents from the put. So in total, we receive 41 cents upfront. All right, so once we set up this short straddle, we would hope the share price would finish exactly at $9.75 1 month later. And the maximum amount of gain we're going to get is the net premium we received upfront, 41 cents. If the share price finished really high or finished really low, we're going to lose money, right? So this negative slope line indicates that we are losing money on the call that we shorted, and this line here indicates that we are losing money on the put that we shorted. All right? And as I mentioned, the short straddle is a very dangerous strategy to enter into because if you look at your right-hand side, there is no limit as to how much you can lose, right? Because there is no upside limit as to how much the share price can increase into. That means because we're on the short side of the call, that means our loss is unlimited. And also we're going to lose big on the put that we shorted. So that's a very dangerous strategy. Your loss is unlimited and your gain is limited. Your gain is 41 cents. That's maximum amount of gain you're going to get, and the loss is unlimited on the right-hand side. Okay, so then people think perhaps there's an alternative way we can take advantage of a really smooth share price and without exposing to this extreme downside risk. The way we can do that, the way we're going to do that is by setting up long butterfly spread using call options. So in the previous example, we set up the short butterfly using calls. So this time we're going to set up the long butterfly using call options. So if you look at the payoff diagram of this long butterfly, you'll notice that you also have this A-shaped pattern, right? You also have this A-shaped pattern. Basically, this A-shaped pattern is us taking the advantage that the share price is really calm. There's very little volatility associated with the share price in the near future. And if you look at the two sides, we managed to cap the loss, right? Our loss at the right-hand side is no longer unlimited, but we set a floor as to how much we're going to lose. And the same thing goes to the left-hand side. We also set a floor as to how much we're going to lose on the left-hand side. Okay, so what's involved to set up this long butterfly? It's kind of similar to the short butterfly. It's just the opposite. So first of all, we're going to long a call option with the lower strike price, K1. And then we're going to long a second call option with the higher strike price, K3. And then we're going to short two call options with strike price of K2. And the K2 has to satisfy the relationship that's the K1 plus K3 divided by 2. That gives us the K2. So in other words, K2 has to be right in the middle between K1 and K3. Okay? So once we set up this long butterfly, again, we're going to look at the payoff table. Okay, so here I wrote the stock price range, and then we're going to analyze the payoff from each position, one at a time. Okay, so let's start from this region here. What if the share price, end up being really, really low, lower than the K1, right? If it's lower than the K1, which means none of the call option is in the money. All of the call option finish out of money, right? So if that's the case, nothing going on with the call that we loaned, and nothing going on with the call that we shorted. So the total gross payoff is 0, is nothing. And you can see from this diagram here, the two call option that we loaned finished out of money. There's nothing going on there. And the two call option that we shorted is also out of money. So whoever on the long side do not want to exercise their call options. So that's nothing going on up here, right? When you combine three nothing going on, what it will get is nothing here. Okay, so that's the floor that we set on the left-hand side. Now, what if the share price get above K1, but below K2? Now, if it's above K1, then the call option that we loaned with strike price of K1 finish in the money, right? So if that's in the money, we're going to exercise the call, and we're going to make a payoff of ST minus K1, right? We're going to make a payoff of ST minus K1. However, the second loan call option finished out of money. There's nothing going on there. And the two call option that we shorted also finished out of money. Because this is the price range which is above K1 but below K2. Okay? So then we see here, this solid line mimics the payoff from the loan call, right? So this two line parallel, which means that the loan butterfly payoff mimics the payoff from the call that we loaned. So that's why it's parallel. All right, so the net effect is we have a payoff from the call that we loaned, which is ST minus K1. What if the share price finish above K2 but below K3? If it's above K2, the first call that we loaned is still in the money, right? It is still in the money, and we're going to exercise that call. We're going to make a payoff of ST minus K1, same as before. However, this time, the two call option that we shorted is also in the money, right? Because that's where the share price get above K2, right? Get above K2. So whoever on the long side of that call want to exercise against us, and they're going to make ST minus K2. If they're going to make that much money, we're going to lose that much money. And we're going to lose double amount of that money because we short two calls. So I put a negative sign in front of that, indicating that we're losing that much money. If you sum up these two columns, the net effect is K3 minus ST. It's just simply some rearrangement there. You can work out the net effect is K3 minus ST. The reason why is because we carefully choose K2 so that the K2 is equal to the average of K1, K3. So the net effect is K3 minus ST. So we have a downward sloping line in this region here. However, once the share price get above K3, get above that, beyond that point, the last call that we loaned also become in the money, right? So we're going to exercise that call, and we're going to make a payoff of ST minus K3. And this time, all of the call option is in the money. We're also going to exercise the first call that we loaned with a strike price of K1. And whoever on the long side of that two call option that we shorted will also exercise against us. Okay? So the net effect is nothing. Now, as you can see, we are making money on the two call options that we loaned, right? So that's the two upward sloping line. And we're also losing money on the two call option that we shorted. That's the steep negative sloping line. And those two would cancel each other out. So the net effect is nothing going on there. In other words, if we analyze this diagram, if the share price finished right in the middle of K2, the maximum amount of gain we're going to get is the net setup cost. However, the maximum amount of loss is going to happen to us is capped at the two sides. So that's advantage over the short straddle. Does it make sense? The long butterfly. And similarly, I'm not going to go detail with the short butterfly using puts. They're very similar. The whole rationale is also that we're hoping the share price would finish around K2. It's really calm and smooth. And the way we're going to set up the strategy is by long the put with the lower strike, K1, and we're going to long a second put with a higher strike price, K3. Then we're going to short two put options with the strike price of K2. And again, the K2 has to satisfy the relationship that the K1 plus K3 divided by 2 give us this K2 here. Now, if the share price finished really, really high-ish, higher than K3, then none of the put option will be in the money, right? So all of the put option finish out of money. Again, we have nothing going on here, right? If the share price dropped below K3 but above K2, then this put option that we loaned is in the money, and we want to exercise that put. So we want to exercise that put, and we make a payoff of K3 minus ST in that region there. Now, if the share price dropped below K2 but above K1, then this two option that we shorted will become in the money. So whoever on the long side of that put will exercise against us. So that's this negative sloping line in the region between K2 and K3. Now, if the share price ends up being really, really low, lower than the K1, then this put option that we loaned, so this put option that we loaned start to kick in, right? So this put option become in the money, and we want to exercise that put to make a payoff of K1 minus ST. Effectively, what we have here is we have two put option that's in the money. So this two positive sloping line means that we are making money on the two puts that we loaned. And at the same time, the two puts that we shorted is also in the money. So we are losing money on the two puts that we shorted. And the net effect is the cancellation, right? So the profit from the two puts that we loaned is canceled by the losses from two puts that we shorted, and the net effect is nothing going on here. So again, once we set up the short butterfly using the puts, we're hoping that the share price is really calm and finish around the K2. And the maximum amount of gain we're going to get is the premium, and our loss is capped at the two sides, okay? So which is identical to this long butterfly using calls. All right, lastly, I want to quickly talk about the bull spread using put options. Because in week 4, I mentioned that the ideal way to set up a bull spread when you are bullish about the underlying share price is that we're going to long a call and short a call, right? So we're going to long the call with the lower strike price, then we're going to short a call with higher strike price. The reason behind that is because we think the increase in the underlying share price is going to be a modest increase, right? So we don't want to pay too much for the call option for a lot of upside potential that we're not going to need. And the one way we can reduce the cost is by shorting another call option with higher strike price. So that was the way we set up our bull spread. Now, the alternative way you can set up a boost spread is by using the put options. Okay? Now, imagine we have a share price that is around 35. Just imagine we have a stock that is currently trading at a price around 35. And you are bullish about the share price. You think the share price will increase in the future. The share price will get above 35. And you are so comfortable, you are so bullish about the idea that the share price will get above 35 that you shorted a put. Okay? Why you short a put? Because you are almost sure that the share price will increase, it will never fall below 35. So you can short the put and hoping there's no consequence that's going to happen to you. Right? So in other words, whoever on the long side of that put will not exercise against you. So in that ideal situation, we can walk away with the premium with no consequence. So that's us bullish about the underlying share price. However, nothing is guaranteed. You know, if everything goes south, the share price can drop. You know, can drop to maybe $20 or $10. If that's the case, we're going to lose big on this put option that we shorted, right? We shorted put option with strike of 35. Imagine if the share price dropped to 20 or dropped to $10, we're going to lose big in this put option that we short. So how can we manage this loss? One way we can do that is by buying another put option with the lower strike price. So we buy the put option with strike price of 30. So that's kind of saying, okay, all right, we are bullish about the underlying share price, but nothing's guaranteed, so we would like to buy an insurance to protect us from the extreme downside risk. Worst case scenario, if the share price dropped below 30, this put option that we bought will protect us, right? So that's the whole rationale behind the boost spread using the put options. Now, we shorted the put option with strike price of 35. We received that money, and we bought the put with the strike of 30, and we pay $4 for that. So the net premium we receive upfront is $3, right? Okay, so once we set up this boost spread using the put options, the ideal situation, ideal scenario is the share price rise above 35. Remember, this K2 here is the put option with the strike price of 35, right? So ideally, we're hoping this share price get above 35. If it's above 35, which is above this K2 region, what's going to happen is that none of the put option finish in the money, right? The put option that we shorted with a strike price of 35 finished out of money, which means whoever on the long side of that put option, they don't want to exercise, right? They don't want to exercise that out of money put. So there's no consequence happen to us from the put option that we shorted. And of course, the put option that we loaned is also finished out of money. So we don't want to exercise that put option either. And we have nothing going on here and nothing going on here. The net effect is nothing going on here. And if that happened, we can walk away from the premium for no consequence. And we can walk away from the net premium $3. So the maximum amount of gain we're going to get is $3. That's when the share price get above K2, get above 35. Now, what if the share price dropped below 35? That's not the scenario that we hoped for. If it dropped below 35, but still above 30, we're going to lose money, right? Because whoever on the long side of that put option will exercise against us. So they will exercise against us, so we are losing money on the put option that we shorted. So this negative sloping line means that we are losing money. And because the put option that we loaned still out of money, so we cannot do anything to protect ourselves. In fact, the payoff from the boost spread at this region mimics the payoff from the short put. So that's why this solid line is parallel to the dotted line. The dotted line is the payoff from the short put. However, that will not go on forever. We will not lose money forever. If the share price dropped below 30, the put option that we bought with a strike price of 30 is going to help us. So that's where this K1, right? So if it dropped below K1 region, this put option that we loaned is going to make money. and that would offset the loss from the short puts. Again, we're going to get a cancellation effect. So we're making money on the put option that we longed with a strike price of 30, and we're losing money on the put option that we short with strike price of